Hello students, this video clip will cover allowance method change from percentage of sales method to aging method. Let me read the question first. From inception of operations to December 31st, ABC Corporation provided uncollectible AR under allowance method. Provision were made monthly at 2% of credit sales. Now, 2% is the provision percentage from the credit sales, and bad debt written off were charged to the allowance account. We are going to use allowance for bad debt under the AR to come up with the net AR, and the bad debt expense account to reduce the sales amount based on the bad matching principle. And recoveries of bad debts previously written off were credited to the allowance account, and no year-end adjustment to the allowance account were made. Okay, that is the allowance policy, allowance method before changing to the percentage of sales method. ABC usually credit terms are net 30 days. The balance in the allowance for debt account was $154,000 at year end. Now we have the beginning balance of allowance for bad debt account. So I'm going to put negative 140 because that is the contra account that reduce this main accounts receivable. So let's just start from here. January 1st, we are creating 2004 balance sheet and income statement. During 2004, credit sales total $9 million. Okay, so we are going to apply 2% of $9 million to set up the bad debt expense and allowance for bad debt this year. And interim provisions for adaptive accounts were made at 2% of credit sales, as mentioned earlier, and $95,000 of bad debt were written off out of 2% times $9 million. We set up 180 plus 154,000, the beginning balance allowance for bad debt. 95,000 of the bad debt are written off. We accumulate allowance for bad debt beginning plus additional 2% out of $9 million net the credit sales. So that is the provision allowance for uncollectible account amount. Out of this amount, we have written off the 95,000 of bad debt that is never be collected. But we also have recoveries of account previously written up amount $15,000. Not out of $95,000 of bad debt, we recovered $15,000. That would happen in real life. We segment classified the bad debt, which will never be collected, but all of a sudden we receive the cash to get the partnership with our vendor or the customer's main account. So they recovered this $15,000 from the previous the written off. So let's start this journal entry. Sales $9 million on credit. So AR $9 million, cash to receive, and the credit sales $9 million. And then because we have the allowance policy of 2% of credit sales should be 2% of credit sales should be recorded. What's that? The adjustment for allowance of bad 2% credit sales, not 2 million. 9 million should be 9 million. Sorry. And then here, what account do we need to reduce the sales based on the matching principle? That's correct. The bad debt expense. Bad debt expense. We need to record bad debt expense. Here we go. And how much is that? 9 million times 2%. Also, we need to reduce the sales the account receivable value with the contra account of allowance or a collectible account bad debt. So it's also same. times 2%. And then adjustment for written off 95,000 bad debt. That means that okay, that amount is never be collected. For example, some bankruptcy of customers, clients. So that definitely is really hard to get the cash from the AR. So that amount is now what account we need, because from the provision we have set up, now we don't need to have this amount any longer because it's never be collected, right? So now we actually reduce AR because it is now determined. Now we can touch this AR. The reason why we did not reduce this $180,000 from AR directly is that was the provision. Right? But now it's not provision. It's written up in the actual uncollectible amount, uncollected amount, not collectible, actual uncollected amount, right? So 95,000 we directly now reduce from the AR, from the sales on account. But we also have adjustment for recovery from the previous the write-off 95,000 bad debt. Now, in this case, we have to recover first this AR value. How much? Not by 95, but by 15,000. And also we have to recover the allowance for bad debt because that was a wrong record. So the same amount. And then the reason why we record recovery 15,000 because we received cash. We received cash 15,000, and then we can reduce 15,000 because we receive cash. The AR recording here and AR recording there is different reason. AR recorded and the adjustment for written up is this AR is never be collected. So we remove this AR 95,000, but this AR on the credit, that means that we received cash. That's why we reduce this the cash to receive asset account. Then let's put all this journal entry on posting the balance and income statement. We're starting from AR 9 million, but AR now we reduced AR by 95,000. Also we increased 15,000 minus AR like this. So we got the AR 8,905,000. Somebody would ask, oh, can we just offset this AR? Yes, you can. Yes, definitely you can. So that you can just express cash up and allowance for bad debt up, just to account. That's fine. But the reason why I'm expressing this two journal entry line is that to show the process, and then it's much better to understand. Then what about sales here? The sales and the bad debt expense 180,000. So we reduce the sales amount. And then AR net. Finally, we want to see AR net 8,000. Oh, we haven't recorded this allowance for bad debt. Starting from the beginning balance 154,000, and plus we add additional allowance for bad debt from the provision of 2% of credit sales, and minus the debit because that is contra account of asset. So allowance for bad debt from the write-off and recovery 15,000 previously written off. So it should be, oh sorry, that is my mistake. So $180,000 was the minus because it should be recorded on the minus. That is contra account of asset. So that is also plus, then also minus the contra account, which is negative. Okay, so we have 254,000. Good. Then we now have changed it. The allowance method, allowance for bad debt, the policies are from the percentage of sales income statement approach to the aging method, because we have a lot of information from the past behavior of a customer payment. So ABC Corporation installed a computer facility, and an aging of AR was prepared for the first time as of December 31st. Now here the classification by month of sales, we have this, and the balance in each category and estimated percentage uncollectible. It's uncollectible. So we have those information, and based on the review of collectability of the account balance in the prior to January 1st, year 4 aging category, additional receivables totaling $60,000 were written off as of December 31st, and 70% uncollectible estimate applies to the remaining $90,000 in the category. So this category. And ABC Corporation adopted new accounting method for estimating the allowance for the doubtful accounts at the amount indicated by the year aging analysis of AR. Now the company changed it from percentage method to the balance sheet approach, the aging method. So let's start from this journal entry work first. Adjustment for additional written off $60,000 bad debt on the category, this aging category. So right, allowance for bad debt. Allowance for bad debt 60,000, and AR, because that is the written off. We assume that we haven't had the provisions already. So out of this provision, we determined that $60,000 is never be collected, never be. So we can touch this AR directly. Okay, so the balance in each category, we can just transfer from this balance in each aging category. But here you have to remember we reduced this by 60,000. So $90,000 is the balance in each category under the prior to the January 2004. So now the AR balance, now how much is the AR balance? AR balance is $2,470,000. That is the AR category, the balance, total AR balance. And estimated percentage uncollectible. Now we also transfer this information into this schedule, and 25. But do you remember, now we have a new percentage of uncollectible estimate. So 70% uncollectible estimate applies to the remaining 90,000. So we change this percentage. Now we can come up with much accurate the uncollectible amount, which is allowance for bad debt, on the balance sheet, the ending balance. So we can calculate in this way this AR balance, that is AR balance in each category, and then in each category that is uncollectible estimate. So let's sum up to get the ending balance of allowance for bad debt. Okay, then let's create the schedule of allowance for bad debt. The procedure to get the additional allowance for bad debt required to meet the ending balance on the aging method is to start ending balance of the allowance for bad debt. So we already calculated. This amount again should be allowance for bad debt as well. So we already calculated. But what we need is to get this additional allowance required to meet the ending balance. How much the allowance for bad debt of that year we need to record. So in order to do so, allowance for bad debt on a percentage of sales method before the change, we have had 200, right? 254,000. That was we have had. Okay, let me show you just plus sign. Then additional return of $60,000 that reduced the allowance for bad debt, right? So I'm gonna reduce to 60,000. Then how do you get? We can just plug in 12,100. We already have this ending balance from the schedule of aging AR. Here, how to get it? Just plug in this minus, open the parentheses. Now, after written up, we have a new balance of this, and then subtracted by 312,100. So 118,100 is additional allowance for bad debt we have to record. So here, bad debt expense and AR allowance for bad debt. Allowance for bad debt we have to record is 118,100, same value. Okay, so we needed to put the still cash here, and then allowance for bad debt we already have here, and then AR. How much is AR here? And then, by the way, we have changed this negative value. So sum of this is AR net. And then sales, we have had the sales. And then the bad debt expense. Now, bad debt expense should be increased. By bad debt expense. Additional allowance for bad debt 298,100. This is it. So we have been practicing how to come up with this allowance for bad debt account under the two different approaches. So I believe that the aging method is much more accurate procedure to get the net balance of AR at the end of the day. Okay, see you in the next video clip. Bye bye.